All right, let's talk about the absolute plumbing of the internet. In the world of networking, a massive battle is going on right now. You've got the established titan on one side and the disruptive challenger on the other. Today we're breaking down this high-stakes showdown, Cisco versus Arista.
Okay, so the best way to really wrap your head around this is the classic incumbent versus challenger story. Cisco, well, they're the incumbent. They are the giant, the fortress, an absolute institution in networking. And then you have Arista. They're the challenger, a nimble, fast-moving speedboat that's just been carving out this massive position in the new world of cloud and AI.
And this brings us to the big question, right? The whole point of this explainer. You've got two incredible companies with two completely opposite reasons to invest in them. So if you had to pick one for your portfolio, which one is it? Let's follow the money and see what the data tells us.
Now, to understand the numbers, we first have to get their philosophies, because this is the core conflict. This is what drives everything else. It really is a tale of two totally different strategies.
This slide right here really gets to the heart of it. On one side, you have Cisco's walled garden. They control everything from start to finish. They design their own custom silicon chips, build a whole ecosystem of software, the whole shebang. And the promise is simple. Hey, if something breaks, you've just got one number to call. Then you have Arista's open road. They do the complete opposite. They use high-performance, off-the-shelf chips, what we call merchant silicon, from partners, and then they pour all of their energy into making one thing, their software, EOS. They make it incredibly fast and efficient, and it's designed to work with pretty much anyone's hardware.
So, a walled garden versus an open road. I mean, that sounds cool, but how does it actually play out in the real world? Let's look at the financial tale of the tape and see how these philosophies translate into cold, hard cash.
And wow, this chart says it all, doesn't it? I mean, look at Arista's growth. It's a rocket ship. They've more than tripled their revenue in just 4 years. How? By being laser-focused on that booming data center market. Meanwhile, you've got Cisco, the massive ocean liner, just kind of holding steady. Its revenue is enormous, don't get me wrong, but it's flat, just cruising along.
But you know, revenue is only half the story. The real question is, how good are you at turning that revenue into actual profit? And here, the difference is just staggering. For every single dollar that comes in the door at Arista, they keep about 40 cents. Cisco? Only about 18 cents. That is the power of Arista's software-first model. They just don't have the massive overhead of designing all their own hardware. And that lean approach, it also means they get a much, much higher return on every dollar they invest back into the company. Okay, let's talk about risk. Let's look under the hood at the balance sheet, and when it comes to their financial foundations, they could not be more different. Arista is a fortress. Look at that, zero debt, and over $8 billion in cash. They are built to withstand pretty much any storm. Cisco, on the other hand, is a leveraged giant. They're carrying over $28 billion in debt. Now that debt is the fuel they use to operate at their massive scale and make huge acquisitions, like their recent purchase of Splunk.
And this difference in philosophy extends to how they generate cash. Cisco is a cash cow. It just churns out a massive amount of raw cash. We're talking around $13 billion. And that cash is used to fuel its dividend and its M&A machine. Arista is the compounder. Its cash flow has just surged from $700 million to nearly $4 billion. And its purpose? To build a war chest for future growth.
And, you know, that brings us to the most concise, the absolute simplest way to think about them. Cisco is an income engine. Arista is a growth engine. One is designed to pay you now. The other is designed to grow your capital for the future.
Which leads to a very simple question for you, the investor. Do you want a paycheck? If the answer is yes, well, Cisco is the income play. It pays out a hefty $6.4 billion in dividends. That's a reliable income stream. If the answer is no, then Arista is the growth play. It pays zero dividends. All of its capital is retained to go after those big growth opportunities.
Now, dividends are one way to return cash to shareholders. Buybacks are the other. And here, too, their philosophies are totally different. Cisco is aggressively buying back its own stock. They're basically trying to shrink the number of shares out there to make the earnings for each remaining share look better. Arista, way more conservative. They mostly use buybacks just to keep employee stock plans from diluting other shareholders, choosing instead to just keep that cash on hand.
Okay, so we've seen their internal philosophies, and we've seen the financial results. But what does the outside world think? Let's turn to the market's verdict to see how investors have actually reacted and what they're betting on for the future. And yeah, this 5-year stock performance chart tells a pretty powerful story. Arista has massively outperformed. Its stock price basically tracks the boom in cloud computing and now the explosion in AI infrastructure. Cisco's stock? It's been steady. It tends to track more with general economic spending. So the market has clearly rewarded Arista's growth. But all that amazing performance, well, it comes at a price. When we look at valuation, Arista is trading at a serious premium, with a price-to-earnings ratio over 50. It's basically priced for perfection. You are paying up for that growth. Cisco, on the other hand, is priced for value. Its lower PE ratio suggests there's probably less downside risk, but it also signals much lower growth expectations from the market.
So what's the next chapter look like for these two? Well, they're placing their bets on very different futures. Arista is going all in on AI. They are positioning themselves as the specialist for the high-speed networks that power AI data centers. Their whole game is to win the next big infrastructure boom. Cisco, meanwhile, is doing this massive pivot away from hardware. They're focused on building predictable, recurring revenue through things like software subscriptions and cybersecurity.
So after looking at all of it, the philosophies, the financials, the future bets, we come to the verdict. And the answer, it really depends on one thing: what kind of investor you are.
Of course, no investment is a sure thing. So what's the bear case? What could go wrong? For Arista, the big risks are that sky-high valuation. I mean, it's priced for perfection, so any stumble could be painful, and the fact that so much of its business relies on just a handful of giant customers. For Cisco, the fear is just a slow decline of its older businesses, the huge challenge of integrating a company like Splunk, and, managing that mountain of debt.
This checklist right here really sums up all the trade-offs, doesn't it? You can see the pattern so clearly. If you want growth, if you want a fortress balance sheet and a pure-play bet on AI, well, all the checkmarks fall on Arista's side. If you're looking for income, value, and shareholder returns through buybacks, Cisco is the clear choice.
So let's bring it all home to the final verdict. Based on this analysis, the choice really comes down to your personal investment style. Cisco seems to be the pick for a more conservative investor, someone who values reliable income, lower risk, and is betting on a broad enterprise recovery. Arista, on the other hand, is for the aggressive growth investor, someone who wants a direct line to the AI revolution and is willing to accept higher risk for that potential of much higher reward.
Ultimately, it all comes down to this one question, which brings us right back to where we started. When you look at your own portfolio and your own strategy, what are you trying to build? Are you building a stable, income-producing ocean liner? Or are you building a high-growth, nimble speedboat?
And of course, just a final reminder, this presentation is for educational and informational purposes only and does not constitute financial advice. Past performance is not indicative of future results, so please consult with a qualified financial advisor before making any investment decisions.